This is what we do when we're educating clients and educating business partners about Index Universal Life. Okay, this is something that our Chief Executive Officer, Mr. Eric Antonio of Exertus Financial Partners, has created, and this is something that we've utilized to help actually make them understand and educate them about how much money they want to put. And when you educate them how much money you want to put in, you always want to emphasize, hey, can you afford $8 a day, 10, 12, 20, $30 a day? Because it doesn't seem like it's such a big number at the end of the month, like $250 a month, $500 a month, $1,000 a month. But literally, this is how we're closing clients that want to put in $250 a month, $500 a month, sometimes even $1,000 or more. It's called I quadrant. Okay, if you master this, it's like a printing press for your business. Okay, and it creates belief for you and future partners. Now, the I quadrant. The reason why I quadrant, we start off because we're going to talk about the 4 I's. Okay, there's a more advanced version of this, but if you learn the basics and master this, it's going to be incredible. Now, the first one is called index. Okay, and I usually draw a line like this, and I tell people, you know, Mr. or Mrs. Client, what usually happens in the stock market? Is it true that it goes up, but also what happens?
Goes back down.
Right? Goes up and it goes down. Something that we're very familiar with in the economy, you know, in the last how many decades? You know, 401k is a good example of this, right? Qualified plans, QP, qualified plans, 403b, TSP, government sponsored programs, IRAs, individual retirement accounts, right? It goes up and it goes down. Okay, what happens, let's say back in 2002 and then let's say 2008, right? The market got affected. So most people are becoming more wise nowadays is when they retire at 60, 70, 80, whatever the retirement age is. Why would you insure your hard-earned funds into something that's going up and down? It just doesn't make sense. Now, there's a use for 401k, but you want to optimize, not maximize, okay? Also, where do most people put their money in right now, aside from qualified plans, such as just these mentioned? They also put in a savings account, correct?
Thanks.
They also put it, let's say, CD accounts, right? They also put, let's say, checking account, right? Let's say safety deposit box, and I usually chuckle because that's illegal, right? I worked at the bank. Under mattress. You laugh, but some people do that, right?
Yep.
Now, some of these pay 0%. Most banks pay 0%, a 1/4%, and hey, if we're lucky, like CDs, 1 to 2%. What if I can show you a vehicle that you can have 13% cap? We call this MP and MP. Market potential, Mr. or Miss Client, and market, what's the other one? Protection. Okay. Potential, because you can make 13%. Also, we have an uncapped strategy where you can actually make more than 13%, 15%, 20%, something most companies don't have. Also, we have a fixed. You want more of a fixed, 4.6%, the highest in this space of the Index Universal Life. But also right here, you have market protection. What do I mean? We have a guaranteed floor of what? 0%. 0%. Because 0 times negative 50%, if the market crashes, is still what? Zero, right? This is where we have 0 is your hero. Okay? So are you understanding, Mr. and Mrs. Client, a little bit about this so far?
Yes.
The old school thinking of insurance is they want the most coverage for the least amount of money paid, right?
Right.
Here, if you know you're going to get 13% or higher, 0% market protection and indexing, is it true that you want to put the most amount possible?
Sure.
Yeah, right? So can you see yourself putting $8 a day, $10 a day, $12 a day? Most nurses would do $20, $30 a day, $500, $1,000 a day, right? That's the indexing. It's very powerful. Why leave your money into something that can not make you money or goes up and down? Now, the next I I'm going to show you leads up to what we call IRC. Okay, 7702A. What is that? Internal Revenue Code, like IRC 401k.
Yep.
It's a revenue code.
Yep.
Same thing here. This is what we call loan provision. Or in other words, be your own bank. In simplified layman's terms. What do I mean by be your own bank? Meaning the money that's being generated here, cash value, it's going to start to grow. Mm-hmm. In 5 years, in 15 years, in 25 years, you're going to have some sort of cash value built up. Yes?
Yes.
Okay. So what I mean by that is, why charge things on your credit card and get the high 18% interest rates? Or your next home, or your kids' college education, or pay for whatever you would like with a new car. Mm-hmm. You can be your own bank. Mm-hmm. Not to mention, we have what we call, this right here is supplemental tax-free retirement income. Very powerful. What do I mean? Depending on your age, depending on your face amount coverage, depending on the amount of money you put in every single month, will determine if you can actually create a supplemental tax-free retirement income. Let me illustrate that for you. I have a couple, husband and wife, $1,000. One's a nurse making great money. The other one's a manager at the airport. We've actually showed him through the indexing and all these boxes why they need to put $1,000 a month. I think that's about maybe $35 a day, something like that, right? Mm-hmm. So through that, I shared with them from 40 to 65, from 40 to 60, 65, about 20, 25 years, mm-hmm. they're going to put $1,000 a month. And they want to do it because they're doing it already anyways in their bank account, okay? Mm-hmm. And why they're doing it is they have small kids. If their kids grow up in age, become 18 years old, that cash value can help them pay off their college education or a portion of their education, right? Mm-hmm. Mm-hmm. And if for some reason that education, actually they get scholarships, they don't need to use it, no problem. By the time you reach 60 or 65, Mr. and Mrs. Client, stop paying for it. We've designed an illustration where you can withdraw $75,000 plus a year for the next 20, 25 years.
How much again?
$75,000 to $100,000 each a year. Mm-hmm. Okay, through the illustration that we've created. Okay, mm-hmm. So every illustration is different. See your own details for results, so to speak. Right. Mm-hmm. So that's what we're talking about. We're talking about, instead of waiting until you're 65 to take out $1,000 for Social Security, we're talking about designing your own supplemental tax retirement income if you do it correctly.
Yep.
Okay,
at the times that you need it.
Absolutely, the times that you need it. Now, the next one is IRC 101G. What is this? Living benefits. By the way, Mr. and Mrs. Client, our living benefits is package built in. Some other companies won't mention it. Extra rider or extra cost. Ours is not. Chronic, critical, terminal. Okay. Let me ask you a question, Mr. and Mrs. Client. Do you think as you age, your health would increasingly improve or start to decrease? Of course, decrease. Mm-hmm. Do you think, as we get older, medical bills will happen more frequently in terms of medical visits or decrease? Of course. Mm-hmm. So it's inevitable, right? Mm-hmm. Chronic is if you cannot perform 2 out of the 6 ADLS, activity daily living. B, C, D, E, T, T. Bathing, continence, mm-hmm. dressing, eating, toileting, or transferring. If your doctor, some other carriers say their doctor, okay, we know some clients, and we're not going to mention any companies, their doctor has to say, you cannot perform 2 out of 6, then you can get that benefit. But it's your doctor, mm-hmm. Kaiser doctor, whoever doctor, mm-hmm. says you cannot perform 2 out of the 6, we can advance you monthly, lump sum, or periodic payment for you, for living mm-hmm. benefits. Critical, as you know, kind of like stroke, right? Heart attack, mm-hmm. all those things that involve critical and terminal cancer, so to speak, anything that's critical in terms of, you're going to die within a period of time, 1 or 2 years, something mm-hmm. like that. So if you have any of these, guess what? You can access this, Mr. and Ms. Client. Does that sound incredible to you or what? Absolutely, right?
Absolutely.
And the last one is what we call instant estate. Will you leave behind your bills to your loved ones, your family? Would you leave behind debt to your family and loved ones? Or will you leave behind some sort of legacy? 100,000, 1 million or more. And what we use is we use the Dimer method to calculate how much instant estate coverage. What is your debt currently? Right? Income replacement is the I. What is the mortgage currently, or rent, education of your kids or yourself, and other responsibilities. We call this other responsibilities that you need to do. Okay? Now, just in this 5-10 minute overview, Mr. and Mrs. Client, do you see the value of our Index Universal Life product?
Definitely.
Absolutely. Especially if you keep maxing out your 401k in California, 18,000 a year. Why do that now when you're young enough at the moment to take advantage of all the tax breaks and all the things that are for you, versus when you need the money the most, you're putting money into the 401k where you're going to lose half of it to taxes anyways. Because most people at the end of the day, when they retire, when they structure this correctly, let's say they have 500,000 in their IUL cash value, 500,000 in 401k, most people think the 401k is worth 500,000. Well, I hate to say it, it's almost 30, 40, if not 50%.
Because
Sliced
at
in
that
half.
time, they are qualified to withdraw. That's the taxes that will
And
be.
not even to mention the 59.5 ruling. If you're not 59.5 or older, then you have an extra 10% penalty on top of the state and federal. This IUL, you can take money out of your cash value up to 90% anytime. Not to mention the 70-year-old ruling, RMD, required minimum distribution, that the government forces you to start taking money out because they said they want their share. Does it make sense? So here is your solution. Thank you.